Welcome back to Eye on the Money, and remember, today on the show we're discussing investments and why that's a good way to grow your money. And with me in studio is of course someone from Centonomy, and that's none other than Michael Thotho, and he's the programs manager at Centonomy. Now, Michael, before we took a break, you are really explaining to us how, as a beginner, you need to make smart moves when it comes to investments. You need to think about your income. Basically, you just need to think about the decision you're making. So you're talking to us about the opportunities available if you're thinking about now growing your income. So maybe if you can just pick it up from there.
Great. And for those the viewers just joining us, before income, we talked about capital preservation, right? Where we said, low risk, low return, right? But there, again, what we're looking at is putting money aside. That money we will need, again, as I said, school fees or rent, right? Great. Now, let's go to income, right? And I was saying a good example of income is a treasury bond. And I was explaining what a treasury bond is, and I said it is us, the citizens, giving the government a loan, right? Great. Now, how does it work? So let's say we invest 100,000, right? And the rate of return is 10%, 10% per annum. So 10% per annum, 10% of 100,000 is 10,000, right? So that means that that bond should give us 10,000 every year. But I said it gives us twice a year, so every 6 months. So that means if we invest in our 1st January, that means that in June we'll have 5,000, and then in December we'll have 5,000 to make 10,000 for the year. And then something else that people need to know is that bonds are long term, right? So they can go to up to 20 years, right? So just imagine getting that amount of income for 20 years. Without doing nothing, just your money being there, it's giving you an income. So that's why I said it gives you income, right? So every 6 months, you are assured of some money in your account. Yes.
So just to pick it up a bit, and you touched a little bit, I saw your face when I said, depending on who you talk to, someone will say the higher the risk, the greater the return. As someone who's in this space, what would you say about that? And that also, in a way, I feel like encourages people to just take bigger, you know what I mean? To jump into a pond that ideally will just drown them as opposed to help them make money. And this is, I'm picking from your reaction. I'd like to get your...
So high risk, Ingrid, does not necessarily mean high return, right? So experts say high risk, high potential of return. So it's not always guaranteed, right? So if you're looking at an investment that is guaranteeing you high returns, then you need to think twice, right? Yes. So high risk, high potential of return. It's not always guaranteed. Yes.
So, Michael, just to pick it up, and you touched a bit on this, right now you can almost not talk about money, business, investments without talking about the pandemic. It has really shifted the way people are doing things. So in line with that, and even when considering where to invest, how to invest, why to invest, how has the pandemic changed the whole dynamic? And even as people get into this space, what do they need to think about? What's important?
Right, but I think the pandemic has impacted almost all areas of of our living, and money being one of it, and a very core part of it, and especially investments, right? Because now you see, if you hadn't invested and you had no other source of income, then you were not at a good place. But if you had invested, then you were at a better place, right? But now also, it's showing us the importance of us starting to do things the moment you have a chance, right? Not always waiting, because especially matters finances. You wait, you say, I'm going to wait until I get, some good money, or until I get a good job, or I get a salary raise to start saving, to start investing, right? So I think what the pandemic has taught us, especially in terms of our money, is if you are thinking to do something, do it now, right? So they say the best time to start saving and investing was 20 years ago, but the next best time is now, actually. Right? So what we can do, us personally, for the viewers watching at home, I think it is to start being smart about our money, right? So always know how your money is coming in, how your money is going out, and then also when your money is going out, the first person it should be going out to should be you, right? So you should be paying yourself by saving and investing, right? And we said why it's important to save and then investing. Now we're talking about investing. We've talked about capital preservation, which is basically a savings account, right? And then we talked about income, which is, basically an investment giving you a salary, right? And then now let's talk about capital growth. Now, capital growth is exactly that. It's you putting your money somewhere and then expecting this money to grow, exponentially, actually, right? And one of the investments that can achieve this is shares, right? Especially in Kenya, it's hard to talk about investments if you don't talk about shares, right? So shares or stocks or equities, that's one good avenue of growing your capital, right? Now, a share or a stock or an equity is just part ownership of a company, of a publicly listed company. And we have publicly listed companies that people can buy shares of, right? And shares are good, first of all, because, again, they give you the opportunity to grow your money. Some shares also give dividends, right? So every year. But now, there are quite a few companies listed in the Securities Exchange. So the decision of which company to buy shares in now is what guys now need to think about, right? Yeah. So I always tell people, when you're looking at a company to buy shares in, always consider at least these 4 things, right? So and you, as you have realized, when investing, research is necessary, is important. Why? Because we are putting our money, and where we are putting our money, we need to be active, right? So I always tell people to be active investors and not passive investors, right? So this means that we always need to do research, see what's happening. Great. Now, even when you're investing in shares, the same is needed, right? Now, when you're choosing a company to buy shares in, first thing you need to ask yourself is, this company, what does it make? What does it sell? That is the product or the service, right? And then you ask yourself, this product or this service, will it be needed 5 years, 10 years down the line, right? Again, investments are long-term, right? So especially when you talk about treasury bonds and shares, invest with the long-term in mind, right? So ask yourself, this company that I want to buy shares in, what product does it offer to the to people? And this product, will it be necessary, needed 5 years, 10 years down the line? So that's number 1, right? Number 2 thing you need to look at is the market, right? So you look at the product, you've seen, yes, so this company X is producing product A, right? And this product A will be needed even 5 years, 10 years down the line. Now, what you need to ask yourself is, the people who are intending to buy this product, are they increasing or are they decreasing? That's the market, right? So first thing you look at is the product. Second thing you look at is the market. The market is the people who are being targeted to buy this product or this service by this company. Are they increasing in numbers or are they decreasing? So if they're increasing, then you put a tick there. So number 1 was product. So if the product checks and it will be needed 5, 10 years down the line, put a tick there. So those are 2 ticks, right? We have the product, tick, market, tick. Now what we need to tick next is the profit. Is this company profitable, right? Because at the end of the day, why we are in business, it is to make profit, right? So we should be investing in companies that are profitable, right? Now, this information is public information, and you will even hear it, even you hear Ingrid, in your news, you will say, oh, company XYZ announced 10 billion profits, right? Yeah. So that's one key thing that you need to consider also, is the profit. So is the company profitable? So when you're looking at investing in the stock exchange, in shares, always invest in a company that is profitable, right? That is announcing, that has been announcing profits through, right? Great. That's number 3. So number 4 thing you need to look at when you're investing in shares is the management of that company. So company X produces product A, right? And we've checked product tick, market tick, profit tick. Now we need to look at the people who make the day-to-day decisions about that company. What is Ingrid saying about that, the leaders of that company,
yes.
right? What are the papers writing about it? You know, what are the people in the streets there, you know, saying? You know, social media is one good place that you can get information. Right? So if you hear some not so positive news about that company, about how things are being run there, then do not invest in that share or in that stock, right? So, so that you don't burn your fingers, those are at least the four key things that you need to look at first, right? And there are others, right? But when you look at those four, you'll be assured of choosing a good company to invest in, right? Great. So we've talked about capital preservation, and this is a savings account actually. We've talked about income. A good income, we said, is treasury bonds.
Yes.
Also, we're in Kenya, so, and we are Africans, and we like property a lot. So also rental property that has that you've built and has people, you know, living there and paying you rent.
Yes.
Then also that also falls under income, right? Great. And then we talked about capital growth, which is basically when you want to invest in shares or equities or stocks, right? Great. Now, before also you invest, you also need to know how much are you willing to put.
Right.
Right?
Right.
Yes. So how much are you willing to invest? Right? Because first of all, various investments will require a minimum amount to invest in. Right? We talked about treasury bonds that will require at least 50,000. All right? We talked about shares. Shares will require now for shares they count with the number of shares. So the minimum number of shares you can buy in a company is 100, right? Great. Now depending on the price share of that company, you will now multiply by 100 to see the minimum you will need to invest.
Right.
Right? Great. Now we've talked about the three aspects, which is capital preservation, income, and then capital growth.
Yes.
Now, and then we talked about the money that might be required. Now, let me talk about collective investment schemes or programs or units that we can now invest in.
Right.
And these are called unit trusts. And why I wanted to finish with this is because I believe that unit trusts should be the entry point to investments.
Okay.
Right?
Okay.
Should be the entry point to investments.
Okay.
Right?
Unit trust.
Yes, a unit trust.
Right.
Right? And what's a unit trust, if I may ask?
You tell me. That's why you're here, Michael.
Great. Now, I know there are people asking, just like you're saying, I tell you, there are people asking, what's a unit trust?
Right.
And a simple way of explaining a unit trust is a chama or an investment group, right?
Right.
So it's just a group of people getting together to achieve what they can't on their own, right? So if you're in an investment group, that should be the main goal, to achieve what you can't on your own, right? So again, that's also how unit trusts work. So people come together, but now these people don't know each other, but they come together through a fund manager, and then they give the fund manager the funds, that is the money, and now the fund manager decides where to invest, right? Now, there are a few examples of unit trust. The first is a money market fund, second one is a equity fund, and then another one is a fixed income fund, right? Now, the best to start with is a money market fund, right? Because that is looks at short term, and then it also gives you compound earnings on your interest, right? So for someone out there asking, or really thinking, where can I start investing? Where you can start investing is a unit trust. So buy a unit trust from a fund manager that is listed and licensed by Capital Markets Authority, right? Now, that brings me to another point, which is legislation, or you need to be authorized. An investment needs to be regulated.
Right.
So that's what I'm trying to say, right? So all investment, a good investment is also one that is regulated by a regulator, right? So the unit trust that I'm talking about will be regulated by Capital Markets Authority, right? So a good investment is also another one that is also regulated. Yes. So if you're looking at unit trusts, look at the regulator, which is Capital Markets Authority. Go to the website www.cma.or.ke, and then look at the list of the licensed fund managers, right? And then you can now decide which fund manager you can use to invest in, to buy this unit trust, whether a money market fund, a fixed income fund, or an equity fund.
Michael,
yes.
I can accuse you of so many things, but I can't even accuse you of not giving us information today. You've done such a brilliant job from taking us from the basics to telling us how to go about it, where to invest, giving real life, you know, areas of how to go about it.
Yeah.
In fact, my director hates me so much right now because time is far too spent, but I can't close without asking you, even as we wind up in 1 or 2 minutes, I'm going to go off on a limb here and ask, with everything you've told us, even advising us how to go about it, look for someone who's regulated, look at the management of a company. Is it making money? What does the market for that company look like? Is investing for everyone? And Michael, I ask this because there's some people who say, no, that just sounds so stressful. I don't want to deal with that. I don't want to deal with, you know, how another company works. I just don't need that headache. I just want my money to sit in my account. I'll put my savings away. There's some people who said, I'm just not built for that stress. So is this for everyone? And for someone who's wary, what would you say real quick as we wind up?
First of all, Ingrid, I'd say that you've been a very good listener. You've been taking notes, and yes, investing can be and is for everyone, right? So what people tend to do is try to make it complicated for no reason, right? And that's where we as Centonomy come in and we break it down so that everyone can understand what an investment is, what investment is good for me, and how much do I need to start? How will this investment work for me? So investments are for everyone, right? But it's just that they are made to be complicated, which we try and simplify and break it down so that people can understand. So yes, investments are for everyone.
Thank you.
Yeah.
You've heard it here. You've heard it from the experts. Thank you very much for watching. You've been so amazing. And remember, this is still part of our partnership with Centonomy, which is still continuing. Yes, guys, into next week. So in case you have any feedback, questions, queries, and also just in case you missed any of our episodes, remember you can catch them on our YouTube channels. They are already up. Send your feedback to our social media handles at Metropole TV KE on Facebook, Instagram, and Twitter. For now, enjoy the rest of your viewing.